Yeah, hello everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro at tastylive. Welcome to the show. Today we are going to be talking about something that may not be on your immediate radar. Hopefully you saw the show yesterday, and so maybe it is. We talked about yesterday all of the various economic news that might be impactful for this week, and very high on our list of what could be market moving, or certainly could be interesting, even if it isn't immediately market moving, as important economic stage setting, is the policy announcement from the Bank of Canada. And here, the question very much is about what's going on in Canada itself, but also how much of a barometer this is for the U.S. economy, which, of course, besides the fact that a lot of us here are in the U.S., is also the world's largest economy, the world's largest consumer market, one of the world's top 5 energy exporters, depending on the month and the level of sanctions elsewhere. So we're looking at obviously a very important economy globally in forecasting the U.S., and Canada being so tied at the hip with the U.S. business cycle is a critical barometer, can be a critical barometer that gives us a clearer picture into what's going on in the U.S. Than can be seen elsewhere. So this assessment of the Canadian economy from the central bank and the actions that they're looking to take in response could be a critical indicator as we think about not just Canada, but the U.S., and from that, U.S. growth, from that, global growth, from that, the general sentiment in financial markets. So hopefully by the end of this, we'll have a clearer picture for how to synthesize what's coming up here in the next day from the Bank of Canada, to be able to glean those kinds of insights and to use those in our strategy, whereas hopefully before there was perhaps less of an appreciation for something like this, and so this will be something new and something useful and something that is perhaps not an arrow in your quiver yet. So let's first take a look at what is expected. And we touched on this a little bit yesterday. So increasingly, it seems like the expectation is that between January and March, so between the meeting that's coming up tomorrow and the one that's coming up in early March on International Women's Day, no less, March the 8th, we are going to have a 25 basis point rate hike. You can see it is currently baked in with about a 77% certainty, so about 19 of the 25 basis points you can see they're baked in. Looking at March, 23% certainty that we're going to get a hike as relative to rates where they currently stand. They're currently at 4.25. We would be looking for them to get to 4.5 between January and March. And you can see that between those 2 months, we have a 100% probability of a 25 basis point increase occurring at some stage between those two meetings. The overwhelming likelihood seems to be that it's going to happen this week. Then, as we look deeper out along the implied curve, we can see that this is seen as being the end of Canada's rate hike cycle. And of course, that already is a story that has U.S. significance because of Canadian dependence on U.S. demand and the sensitivity of that economy to what's going on in the U.S. business cycle. In fact, until very recently, when Canada's provinces finally managed to have some sort of a trade agreement in place amongst themselves internally, each province actually had a better and more frictionless trade relationship with the U.S. than they did with each other. So that just illustrates, I think, how important the U.S. business cycle is in shaping what happens in Canada. And you can see here that at least looking at expectations for what's going to happen in Canada's case, we're looking at this being the rate hike that ends the cycle. We're looking at also a turn in the cycle by the end of the year. So you can see rates peak out there mid-year at about 4.5, and you then start to move in the direction of easing. So come September, you're sort of starting to see the likelihood for easing building. It looks like between July and September, you have about a 60-70%, almost a 70% chance for easing occurring there. That starts to really get acute as you get into October and December, and you can see we end the year at 4%. So essentially the expectation is you're going to start to see rate cuts that bring us down substantially and have us give back not only the 25 basis points that we're going to see here, but some of the tightening that we saw last year in these announcements that are coming up. Now, this, of course, is to some extent a referendum on what's going on with Canada's economy. But of course, as we say, it is also a referendum on what's going on with U.S. demand. But of course, the key question is, how much of this do the markets already expect? Because needless to say, if it's already expected, it is not an active object of speculation. So what we're looking for is any kind of deviation from baseline to actually create momentum in financial markets. So first, I think we take a look at the way the yield curve shape has evolved since the last time that the Bank of Canada met. That was on the 7th. I'm giving it a date to settle here and looking at the yield curve on the 8th, which is the subsequent day, up through now. And what you see is the curve hasn't really changed in a meaningful way. It looks like we got a little bit steeper going into the peak in rates at 450. We got a little bit shallower thereafter, so maybe a little bit of a faster, slightly faster road into the peak, and then a shallower curve thereafter, meaning a slightly more aggressive easing bias, but very little changed here. So the markets are not really tinkering with their policy expectations for Canada and for the U.S. as an extension then, as a consequence of the past month's events. Having said that, not all is as sanguine as you might expect. So here, there's an interesting dichotomy between what's going on with inflation expectations. Of course, Canada, as with the U.S., embarked on an aggressive rate hike cycle for the past year to contain inflation, and what's going on with the dynamics of the economy itself. You can see that since really the beginning of last year, there's a very clear parallel relationship between how well Canadian economic data is doing relative to expectations and inflation forecasting. The inflation here, as implied by bond markets, that's the 5-year benchmark break-even rate. That's the level of inflation expectation over that 5-year window implied in bonds. That's the difference between nominal and inflation-adjusted bond yields. You can see that close relationship between where those inflation expectations are going and where the Canadian economy is headed in terms of how economic outcomes are performing relative to expectations moving very closely until essentially October. And from there, you can see we have a pretty meaningful divergence. Inflation expectations have fallen quite a bit, but the growth numbers, the economic dynamic numbers, seem to be doing better than expected, increasingly. This is an interesting dichotomy. If you believe the red line, then the BOC can't quite rest on its laurels. If you believe the orange one, there's a significant downturn in the business cycle, and it may be time to start backing off. So let's look at what's going on. What you see here initially is the red line, manufacturing PMI. That's essentially a more real-time barometer on GDP. That's heading lower and is now sub 50, which means that we're seeing contraction. Consumer confidence, you can see, was weakening even before we saw that downturn. That's the weekly economic mood index. That's a consumer confidence survey that Nanos Research puts together. You can see consumers were already starting to anticipate a downturn before the actual downturn started. And then you can see that 5-year break even move lower as growth goes down. Let's unpack some of these catalysts. So first, the blue line there, that is Canada's benchmark rate, the BOC target rate, the overnight lending rate. You can see as that goes up, so too economic activity slows. Again, you can see there it's sub 50, just around that 49 level, so giving us a moderate level of contraction in Canada's manufacturing sector as a sort of leading indication for what's going on economy-wide. Not surprising, of course, given the tightening. You can see also that very same tightening is giving us the pullback in inflation expectations, and now we're sort of hovering around the 2% level, which of course is right in the middle of the Bank of Canada's 1 to 3% target. So this is just about Goldilocks for inflation expectations. You can see the tightening brought down the economic growth story, and that in turn moderated inflation. In fact, by the looks of things, inflation may have already established a longer-term peak. So if we look at the makeup of Canadian inflation, we can see that close to 30%, taken narrowly, is shelter, so housing. And of course, another 14%, which is a sizable chunk, is housing-related things. So furnishings and homewares and various things tied to housing. So altogether, the cost of housing is a tremendous component of Canadian CPI. If we look at house prices and we take the year-on-year rate, that's the orange line there, and then we take Canadian CPI and we lag it 10 months. So we pull it 10 months into the past because house prices began to rally and then to fall well before those same changes in overall CPI. That should not be unexpected. We have, of course, different levels of speed of response in different parts of the market. But because this is so commanding, you can see here where the start and where the end of the relationship occurs. And it seems to be about a 10-month lag in this cycle. So if you pull it back, you can see that inflation starts to rise as housing costs start to build in sort of the early to middle of 2019. It now appears to have been the case that we've peaked in both. And if this decline in housing prices continues, it seems like we have quite a bit more room for Canadian CPI to come down. Again, remember, the red line is pulled 10 months into the past, so that the orange one extends quite a bit further down, would suggest that there is a significant amount of pull lower on the red line in the months ahead. So arguably, the Bank of Canada's job is, for the most part, done here. But as with all major economies, the main catalyst for growth, the main engine of growth, is household consumption. In almost every major economy, household consumption is something like 70-75% of overall economic growth. Canada is by no means an exception. And here, it is very interesting to take a look at this bit here that we noticed earlier. Look at that that orange line there, that consumer confidence line, and notice it started to decline well before the rise in rates gave us a pullback in actual realized growth and then in inflation expectations. We got a fairly early start to the decline in consumer confidence. Let's isolate that relationship. So what we see is the decline in Canadian consumer confidence seems to have had the same turning point as the 5-year U.S. real interest rate. So the cost of money in the U.S. adjusted for inflation. And you can see that by the middle of 2021, 5-year money in the U.S. actually has a negative return. It is actually net of inflation. Interest rates are actually negative, because inflation expectations have jumped to such an extent and rates are still ostensibly near zero. What you then get is the Fed rate hike cycle, and so the cost of capital starts rising such that we are now at some of the highest levels that we've seen in recent history. Of course, not terribly rich, still right around the 2% level for 5-year real rates, but nevertheless, much more positive than we'd been, let's say, in the past several years, maybe even in the past decade or so. And then you see the response from Canadian consumer confidence, which really paints the story that U.S. demand, what's happening with the U.S. business cycle, is a really key indicator, not just for what's happening in the U.S., but for what's happening globally. And so what we see here is the contagion from U.S. rate hikes, from the tightening of dollar credit, of U.S. dollar credit, into an adjacent economy. We're seeing consumers respond. This is before we get Canada's own rate hike cycle, which you can see here doesn't really begin until meaningfully later. But consumers pick up on what's going on with rates quite a bit earlier. And so you get this immediate response. It may be then that what we see in Canada is a kind of canary in the coal mine for what's going on in the US, where there's still this rabid focus on where the Fed is going next, and perhaps with this upcoming policy announcement from the FOMC next week, that conversation can transition. But to really demonstrate why this is happening, consider, for a country as large as Canada, the overwhelming majority of the population lives within a stone's throw of the U.S. border. You can see the population density there, absolutely hugging that U.S. border. And so the messaging from the Bank of Canada that we are going to hear over the next 24 hours might be very impactful for what we think about the U.S. business cycle. Of course, just earlier today, we got a set of PMI numbers out of the U.S. that suggests that yet again, now for the 6th consecutive month, we are in contraction. And although that's not necessarily showing up in how vigorous U.S. equity markets have recovered, and really global equity markets have recovered since mid October going into November of last year, around this idea that maybe the Fed is done, the missing piece might well be, well, what's actually going on with growth in the world's largest economy? And how is that weakness that's happening there now as a consequence of this very aggressive tightening? The U.S., of course, did even more tightening than Canada by 25 basis points last year. That we are missing still in the market narrative an appreciation for a meaningful downturn in the largest single source of global consumer demand, in the biggest economy, in an economy on which so much depends in other countries, where whole economies, Canada, of course, being a dramatic example, as you can see here, are built around servicing U.S. demand. And so we get into a situation where if, let's say, the Bank of Canada doesn't give us a hike, if the guidance that they provide suggests we might move up subsequent cuts a little bit earlier in the cycle, well, then we might be looking at a relatively risk-off kind of messaging that then might inform what we hear from the Fed next week, and perhaps even more importantly, inform how the markets react. Central banks are generally not in the business of changing their mind quickly. And so you might get a situation here from the Bank of Canada that feels relatively status quo, but which then sets up a relatively status quo Fed for next week that's ready to sit on its hands. That would go some way toward removing a degree of uncertainty around that Fed announcement, although certainly not all of it, not until it's fully done and in the rear view. But nevertheless, it might help to establish a kind of buy the rumor, sell the fact narrative around that Fed announcement, whereby we get a Fed that confirms for markets that indeed the peak in rates is where everybody thinks, that indeed we are considering some degree of easing, perhaps as early as the beginning of next year from the FOMC. And then the next object of speculation becomes, why is the rate hike cycle ending? Is it only that inflation has been contained, or is it the cost at which it has been contained? Which is a global economic downturn with clear spillover effects into other major economies, with Canada, of course, at the front line because of the proximity and the leverage that you can see here, even geographically, to what's going on in the U.S. So in the tone that the BOC adopts here, we may well get the kind of thing that is going to drain some of the hope and yearning for a soft landing, and really shift the focus to, we are in a very contractionary growth environment. That's going to have an influence on earnings. That's going to have an influence on the availability of cash. It might give us a run-up in the U.S. dollar as there's more concern for the access to that cash and to financing. And certainly there may be a knock-on effect on broader risk. You might see stocks lower. You might see cyclically minded commodities like oil or copper look a bit weaker. And although the FOMC will probably still be the focal point, and we're not likely to build a tremendous amount of immediate follow-through just after the Bank of Canada itself, other than for perhaps 6C of the futures, that's the Canadian dollar, the futures contract. What we could have is a very, very helpful lens into what the FOMC outcome might then look like, and a good bit of foreshadowing to prepare us. So a key indicator in my mind, and something that I am going to be watching very, very closely. That's it for us here today on Macro Money. We'll of course, be back tomorrow to continue dissecting the economic news flow before us. We still have key releases in U.S. GDP and in the PCE indicator of inflation, the Fed's favored gauge, ahead of us this week. In the meantime, if you want to follow any of my thinking and commentary on the markets as they move, that's on Twitter at Ilya Spivak. In the meantime, good luck out there. I'll speak to you all tomorrow. Take care.